Hey everybody, welcome back into Mining Stock Daily. This is this week's long form episode. Trevor Hall here, your host. We got one segment for you. A long conversation with a friend of mine who's never been on the podcast before from Arlington Group. His name is Simon Catt. Arlington Group calls home London, but we find Simon on the shores of Italy. So happy Simon could take a few minutes out of his summer break to share some big thoughts here, not only on junior mining and the commodities, but also a lot of these macro themes we're seeing. We talk China, we talk Japan, obviously we talk a lot about the US and what's going on with the economy here and specifically the bond market, but we also talk a little bit about this rise of Saudi Arabia that we've been getting a grasp of for the better part of the last couple of years. So, great conversation with Simon, and I think you're going to get a lot out of it. Special thanks to Western Copper and Gold, Fireweed Metals, and Arizona Sonoran Copper for their continued support of the podcast. You can go to miningstockdaily.com to see a full list of all of our partners here on the podcast. And if you wouldn't mind, hit a review, a like, a subscription, or even share these podcasts or the YouTube channel with your friends and colleagues. All right, everybody, let's jump into my conversation with Simon. Have a wonderful weekend and be well. Hey everybody, welcome into Mining Stock Daily. This is this week's long form episode here on the podcast. Happy to welcome in a friend of mine, but new to the podcast. I was able to meet Simon Catt last year at the Beaver Creek Precious Metals Summit. We've stayed in contact over the last few months and throughout the year, and we've had a lot to talk about. In fact, I even got to spend some time with him in his neck of the woods next to his office there in London. He is the director of Arlington Group Asset Management, obviously in London, but right now we find him off the coast of Italy. Simon, you're looking nice and bronzed and tanned and relaxed this summer.
Hey Trevor, I did go for a run 11 a.m. this morning, and that was way too later than normal, way too late. It's 30 degrees and pretty crowded the footpaths down to the beach, I can tell you.
Well, it's really it's a real pleasure to have you on the podcast. I'm glad we could get this done. So, thanks again for your time. I know it's a busy week for you.
Absolute pleasure, buddy. Anytime.
All right. So because this is your one true curtain call here on the podcast, Simon, let's get a sense of who you are, your background, your experience, and then let's talk about that you personally before we talk about really what Arlington does.
Sure, buddy. So I'm a 52-year-old Australian, lived in London 25 years, been working in finance for 30 or 40 years. I don't have any professional qualification as a mining guy, but normally when people talk about me, they say, yeah, Simon, he's that mining salesman in London, that Aussie mining salesman in London. And now in Italy, as you said. I've got an Italian wife, by the way. So I moved to London in 98. I've worked for Canadian investment banks most of my career. They were in succession, Royal Bank of Canada, then founded the Hayward UK European office, founded the GMP UK European office. When I took my team from Hayward to GMP, Hayward struggled on for a while and shut that down, and then GMP actually shut me down back in 2016. I remember real clearly my friend and my chairman, Gene, calling me from the airport in Toronto as he was about to fly across here and said, Caddy, can we meet at the Mayfair Hotel tomorrow morning at 9 a.m.? I'm like, oh shit, Gene, I guess the meeting today, the board meeting of GMP Global didn't go that well. He said, nah. I said, shall I call the compliance guy to come and meet us at the Mayfair Hotel at 9 a.m. tomorrow? He said, I've already called him. Oh, good. Okay, buddy. So that was February of 16. Then at the time, an industry acquaintance of mine and now a dear close friend that I call my business partner, Charlie Kenner Brooks, called me up in early 2016 and said, hey, why don't you bring your business, which is mainly financing and advising mining companies, over here to my business, which is called Arlington. So Charlie started Arlington back in 2004. It started life as a little fund manager, managed about $100 million, mainly an Aussie Kerry Packers family money. And then by the time I found him, or we found each other, Charlie had a couple of small London Stock Exchange vehicles. One of them we've since turned into a royalty finance business called Duke Royalties, listed on London. Ticker is simple to remember, Duke, D-U-K-E. It's got 150, 200 million pounds of assets. That's about its market cap as well. But really, we're known as the guys that give access to mining companies access to our European and global relationships, institutions, and high net worth individuals.
Well, it's interesting. You mentioned the background of going from Haywood to GMP, but you talked about your team, and I mean that's a whole different a whole different realm of the business I'm unfamiliar with, Simon. I mean, do a lot of the times do I mean you mentioned the team. I mean, a lot of times do these teams kind of move together from house to house when as things kind of evolve?
Yes and no. I think people, of course, in any business are the most important thing. They create the culture of the business and whether it succeeds or fails. Yeah, I had a team of 11 people at Haywood, left one behind, took 10 at GMP. I spent an increasing amount of my time. What you find is in good times, people want to come and join you. In bad times, they want to leave. And so the bigger the business gets and the tougher the cycle is, and of course, commodities are really cyclical, the more time you have to spend on hiring and firing people. So what we do now is if you walk into our office, you see about 20 people in London, but they work for companies that we've created rather than directly for our firm Arlington. We have one employee. Charlie and I are 50-50 partners in the business, and we find that way it's lean and mean when we go through the down part of the cycle, as we are now, have been for the last 2 years or so. So we don't have to spend all that time focused on HR.
So is Arlington Group could it be like classified as a and correct me if I'm wrong, but more or less an incubator of junior exploration companies and providing those platforms to get traded?
Yeah, incubator, financier. Another phrase that we use is merchant bank because we put our own money into stuff that we do. Our
Mm.
principles are simple. We like to try and finance companies, management team, mineral ore bodies that we think will come out of the ground and that are decent people at a reasonable price. Everybody can make some money. We like to put our money to work alongside our clients. We think that aligns our interests. And of course, different commodities, different stages of companies' life cycles work at different times in the cycle. So, for example, a year and a bit ago, April last year, we listed a company which we called First Tin PLC on the listing. We'd done a prior round a year previous at 15 pence. We listed at 30 pence back in April last year. Went to close our books on the First Tin, £20 million financing the day that Putin invaded Ukraine. That was sort of back in the first quarter of last year. So our problem of having a book that was 2 or 3 times oversubscribed, the tin price at that time had doubled in the previous 12 months, was suddenly taken away. We didn't have that oversubscription problem anymore. But that was at a different stage of the cycle. So to your question about what do we do, we put about £3 million of our money in there at about 3 times on average the current price, which is 7 or 8 pence a share. The IPO came at 30. We put our money in at an average of sort of 20 something, including plenty at 30, also in the private round of 15. So, but what we've learned is, and to help describe Arlington, is when stuff takes longer, costs more, or goes wrong, if you have an active hand in management, and my partner Charlie is the chairman of First Tin PLC, and we recruited the CEO, then you can do what needs to be done through the tough part of the cycle, cutting costs, focusing on the things that will get you through until that money is available again, whether it be ours or other people's.
There's a number of companies that are on your books, and people listening to this podcast for the last couple of years will obviously be familiar with them. Obviously, Discovery Silver partner of Mining Stock Daily. Salazar Resources obviously doing really good work there in Ecuador. You mentioned First Tin. And so, I mean, I would recommend going to the website and taking a look at the list of companies that you work with here. But Simon, you mentioned that you didn't really have a mining or resource background. It really was predicated on investment banking. I mean, what was it back in your career that kind of got you hooked on resource exploration and those equities?
Trevor, it's simple and reminds me of a question somebody asked me. The CEO of a London-listed African gold company said, "Caddy, why are you still in mining?" And I said, "Well, because I really enjoy it. I find it fascinating to try and figure out which piece of geology will turn into a economic ore body, which commodity will go up next. Compare one ore body to another. You mentioned Salazar in Ecuador. Try and figure out what's going on politically in Ecuador, et cetera, et cetera. And hopefully over time you get better at assessing those risks. So the guy asked me the question why I was still in mining. He was in a hurry to retire his CEO role of a London-listed African gold company. And he thought he wanted to go off and work in tech. I'm a West Australian, so I grew up around the dinner table talking about the latest lithium, the latest tantalum discovery. They were one and the same, by the way. Now the world's largest lithium mine in West Australia called Greenbushes. Used to be a tantalum mine and still is, but now the lithium is worth a lot more. The latest nickel discovery, that's sort of in my blood. West Australia and the Australian economy is driven by its resource exports, and they change over time: gold, coal, iron ore, and today lithium, etc. So yeah, so I've learnt the minerals mining stuff by osmosis and experience, but not actually trained as a geologist or an engineer.
And I guess not only why the transition into London, but the impact that your career into London had. I mean, what was it about going from West Australia to London that really, let things really blossom?
Mate, it was just the instinct of a young man to get out and see the world. I remember I was working in Sydney. I'd done 4 years work experience for an Australian firm called Hartley Poynton, which is now part of a firm called Euroz Hartleys in West Australia. I said to my boss, "Hey, Andrew, I want to do what you did. I want to go offshore, work in London for 2 years, then I want to go to New York and work there for 2 years, then come back here to Sydney and run the firm." And he said, "Great, well, just give us a few months. We're in negotiations with someone to come in and buy a stake in the business, and we'll find a job for you in London." So I said, "Great." So luckily for me, Royal Bank of Canada then bought a 20% stake in my then employer, Hartley Poynton, and I took a 90% pay cut and moved to London. So I went to London to see the world. RBC, I recall, were paying me £25,000 a year in my first year of working for them as a junior equity sales guy. And eventually all of the Australian analysts that were working either for the firm in Australia or in London, they all left. And so, back to your question, how did I end up being a mining guy? The head of the mining team in London is a guy called Chris Orchard, nice guy. He said, "Simon, do you want to do global mining?" Because my other two guys had left. And I said, "Sure, I've got nothing better to do." So I became the global mining salesman in London. I had a couple of partners in places like New York and Toronto. And there's a guy in Canada who was pretty well known if you know the industry. He then went to, after working at RBC for 12 years running the global mining group, Ernie Nutter went to Capital Group and ran the global mining research function and the portfolio management function for Capital, the big fund manager there. So Ernie taught me global mining. And here we are today talking about mining.
Well, you've just been all over the place. You've seen a number of cycles here since you've went out in your career here. So let's talk about where we sit here currently and your thoughts and how you are approaching these markets. And Simon, I think one of the things I'd like to do is not just talk about how tough and challenging these markets are. Let's provide a little bit of silver lining if we can as the conversation continues. But we do know there are challenges. You just mentioned a few minutes ago about this, almost 2 year bear market we've had in junior exploration equities, and I'm sure I'm sure Arlington is one of those institutions that really has felt this after being very successful in 2020 and prior to that, putting companies together. But from where you sit, can you describe the current market challenges that Arlington and similar houses such as yours are feeling right now?
Sure. Yeah, I like your idea about making to keep a silver lining on this, because otherwise we just get too depressed. Um, yeah,
Right.
look, the end point of any conversation about mining, junior mining, is that we know that the cycles come and go. You tend to get 2 or 3 good years, and then about 5 or 6 tough years. We're just in one of those tough stretches right now, but we know the good times come again, and it's always a function of the commodity price and the overall stock market. Because as my old partner Ernie Nutter used to say, so these things are equities first, and they're mining equities second. So if the stock market's falling, as it generally has been for the last 2 years, although of course this year, led by tech, the S&P's been actually pretty strong. Just hasn't, the materials and the miners haven't done very well. We know that their time will come, and they're certainly inexpensive. The biggest mining companies are trading on PEs of 8 or 9 times for BHP, Rio Tinto, Vale even cheaper. And over the course of the cycle back in 2010, these things were trading at double those multiples, and they were growth stocks, and it was the Chinese super cycle that was going to be strong forever, so you could pay more for them. So, of course, your question, or if the subject is when do things get better for junior mining finance, I think first of all the bigger companies have to get re-rated, and we're watching the M&A cycle. That's telling us that the big companies think it's cheaper to buy and build. Glencore recently made an approach for tech in Canada. I think there's a long list of suitors for that. Vale is spinning off their base metal business. That's got some outside investment from the Saudi government. They're a logical buyer. Newmont might be a buyer of the of tech as well. We've seen Newmont buy Newcrest in Australia. Of course, they spun that out about 30 years ago. Now they've bought it back. So, and BHP bought Oz Minerals in Australia. So I think the industry is telling us cheaper to buy than build, because the commodity prices are pretty high, and so the sunk capital of those existing mines is twice as valuable as it used to be, because the cost of cement, the cost of energy, the cost of the trucks, the cost of the people has gone up a lot, is continuing to go up at double-digit rates. I, for one, think that the Saudis and the Russians, OPEC Plus, will be successful in pushing the oil price back up well above $100 in the coming year or two. And then as those big natural resource equities get taken over, as they go back up to get more of a mid-cycle rating, which is, say, 50% above where they are today, then I think the cash starts to come down to the juniors. And if the overall stock market is falling, that's not going to help. But I think we're really close to a rotation. We're waiting for the broader cyclical turn in natural resource equities for Chinese growth to stop falling. One thing that I think is a misunderstanding and is misrepresented by most of the media that I read, Trevor, you might read some other more China-specific media, is that China is in deflation. If you read the glass half full version of Chinese deflation, actually, Chinese deflation is caused by the basing effect of oil prices in the first half of 2023 being 30 or 40% lower than last year. But actually, oil prices going back up again. So the opposite will happen in the next 6 months. And that's just because the CPI has food and energy in it. But if you go underneath that to core inflation, as the Federal Reserve and other central banks like to usually use, that shows you that China has still actually got the kind of inflation that we all now dream for. It's running at sort of 1 or 2% a year, core inflation, and the oil price is going back up. So I do think that the days of big Chinese pumping, using debt and SOEs to drive infrastructure growth, I do think that's behind us, and we have to look to the Chinese consumer to drive their economy. China does have issues with debt, but I think that generally the state of China has made good decisions in terms of taking them into things like EVs, therefore for battery metals, and there are headlines around today about them potentially putting restrictions on critical earth quotas again. So China will continue to be really central to commodities demand because most commodities are about half demanded by China. And China's actually doing just fine. And I think the rest of the world is probably starting to slow down.
I mean, it's an interesting that you say that, because a lot of the media we're getting here in the United States, which is obviously leading to a pretty good sell-off in not only equities but also the bond market this week, is on the back of news out of China. I mean, it seems like every day this week we've woken up to new news, including China. They're not going to publish their uh, uh, young worker unemployment numbers. So that, and I had to do some digging into this. That they consider that ages 16 to 24. It's pretty young. But it sounds like that the last record that unemployment number it came at over 21%, Simon. And so they're going to stop even publishing it, and they're not even going to skew it. They're just going to stop publishing it. At least that's kind of the sense we get here. There's rumors this morning, as we record here Thursday morning, that the communist government is looking to keep banks from selling equities because the index has been falling the last couple of days. And so, it's interesting. If you're going to run a capitalist system, obviously there's going to be ebbs and flows, spikes and troughs to the cycles. But we're seeing it obviously seems like there's a little bit of it's indication that the Communist Party is going to try to step in and save the system here. I guess following up with that, Simon, is what does this mean? If China is indeed in this downtrend and that reopening never came into fruition that a lot of people were expecting in the first quarter of this year, what does that mean for commodities in a general commodities cycle? Because the last time we had a super cycle was based on China buying. And the news we're getting here, it doesn't seem like China's in a position to be buying right now.
Yeah. So firstly, I think we should remember that the same way that Chinese and Russian citizens consume propaganda, we all consume propaganda as well, and that the media has different biases. The mainstream media in the West has different biases to Chinese and Russian media, but nevertheless, it's written with a certain slant by the media who might have a narrative about Chinese state control and meddling with capitalism. Trevor, I would guess that you and I are both capitalist guys. We work in finance, so we do that because we want to make a reasonable living, and we believe in the unseen hands of the markets being better decision makers than governments. So yeah, the Chinese capitalism with state interference is different to the model that we know. But equally, if you think about how they can get things done, how they can suddenly in 10 years build an auto export industry that didn't exist 10 years ago, and now they're the best makers. If the reviews that I read, because I haven't got a car at all, by the way, but I have had a look at a few with a view to getting a car as a service here in Italy, where you pay about 600 euros a month. You get a Chinese-made Volvo, because Volvo is now owned by Geely, a Chinese automaker. And the reviews that I'm reading they're pretty good. They're half the price of a Tesla, and they're just about as good. So look at the success of Chinese state control in EVs as compared to, say, Japan, where they seem to have missed this EV, in Germany, where they seem to be falling behind the Chinese in terms of the cost and the quality, but both seem to be, well combined with China's influence of the state there. So, yeah, I don't think that we're going to see as much capital intensive, material intensive growth in China as we saw in the last 10 or 20 years. But I think if we, as commodity guys, can figure out which industries China wants to champion, critical minerals, battery metals being an example, then we can hopefully get on the right side of that trade.
Let's talk about another Asian country. That would be Japan here. You had sent me something in preparation for this discussion, Simon, which I thought was really interesting. Japanese investors obviously also looking for yield. That's been a topic of sorts regarding their yield curve control. Just kind of curious, what your thoughts here on Japan as they, and their kind of use of U.S. treasuries here. Is this something? Are we seeing a little bit? I guess on top of that, are we seeing a little bit more contagion here as the sell-off in U.S. treasuries continues? Is some of that coming out of Japan as well?
Yeah, I think it's really important. When I recall the biggest options trader in the Sydney market back in Sydney when I was learning to be a stockbroker in the mid 90s, telling me that he said you could always tell when the Japanese were investing in the Australian market. They called it the Tokyo Express. He said when the Japanese money started to head down in Australia, it would always be chasing yield because recall the Japanese bubble of everything when it was the biggest stock market in the world peaked back in 1989, and asset prices then started their deflationary slump, which has just finished in the last 6 months. That's really important because Japan's one of the fourth richest countries in the world, or in the G4, I should say. You've got China, US, Europe, and Japan. They've got $3 trillion of offshore savings, and as the finally we've got 4% CPI inflation in Japan. We haven't seen that for all of my certainly investment lifetime. And they're taking yield curve control away. What that means is the largest two holders of treasuries, Japan with over $1 trillion, China, who used to have more but are now down to around $800 billion, are sellers of the world's deepest, most liquid market. And of course, the Fed is increasing its holding of treasury bonds, albeit as trying to step back from QE. So if we look through the next year, I think it's negative for other asset classes where the Japanese have owned bonds in, for example, emerging market currencies, treasuries, seeking yield. They tend to own not junior mining shares, but the bigger mining companies. You see them investing directly in ore bodies to buy a copper supply. You see them investing in oil and gas fields to give them natural resource supply because they haven't got much of their own. But I think it's negative for treasuries and negative for asset classes where they've got existing holdings of yield-seeking investments that are now going to head back to Japan over the course of the next few years.
Money's going to return home.
Exactly, and so the Japanese are going to step back from holding their yield down. I believe that the range for the Japanese 10-year bond has now moved up from 0.5% to 0.5% to 1%, and that will gradually head upwards as they get secure that they've got inflation has returned to their economy after 30 plus years of deflation, and we'll see money heading home.
Another country I would love, we don't need to spend a whole lot of time on it, but I just want to pick your brain here, Simon, and that is really I don't know if you call it a resurgence or the rise of importance of Saudi Arabia right now. And it's not just from the oil market. Like, there's a lot of mineral exploration happening in Saudi Arabia, in very prospective areas of the country and that part of the world. We've seen the likes of Ivanhoe and Robert Friedland take a pretty strong stance of wanting to be the group that goes in there and explores as best as they can in partnership with the Saudis. But on top of that, and he's stepping away, it's also been interesting as a man of sport and loves to watch, the football, how they're just incredibly willing to spend a lot of money on players to come to Saudi and play. And I just think that's emblematic of, what is happening to put Saudi on the map as a very developed country in this world. And it's happening like increasingly every day. I just, and so I know this, I'm kind of spurring this on you, but have you given thought about this rise of Saudi Arabia, not only from resources, but also as in culture and societal recognition?
Yes, in a word. Let me ask you a question before I elaborate. Have you read the book Blood Oil about Mohammed bin Salman?
I have not.
It's a great read.
Okay.
I don't always get through to the end of every book I read. I'm just finishing. I'm in the last chapter of Material World, also worth a read, written by a journalist, a Sky journalist in the UK. I didn't think that would be that interesting because my world is material world, and therefore I thought, what would a journalist be able to tell me? But that was really interesting, worth reading Material World as well. But Blood Oil, the author of Blood Oil seemed to not like Mohammed bin Salman, the Crown Prince of Saudi Arabia, very much. Gave me a few insights into it. Did make me want to go to Saudi. It did not make me want to go to Saudi Arabia, given his view of the world. But gosh, yeah, I do think it's really important. Another anecdote on Saudi Arabia, which is worth mentioning, is a friend of mine, a guy called George Cheveley, who runs a fund in London called 91. It was previously known as Investec. George said last year when he went down to the February conference in Saudi Arabia, they've just got this mining conference going. He said that was the most important and interesting mining conference he'd been to for 20 years. Because he said you could feel the wealth moving around, that things are changing. And of course, the single most important natural resource asset in the world is in Saudi Arabia. And I have this in my head because it's freshly read in Material World. It's the Gawar. I'm going to get the spelling slightly wrong, but it's something like Ghawar, and it's 1,000-kilometer long oil field, and that in terms of the source of primary energy, that has a double digit. That alone is a double digit source of energy for the whole world since it was found back in, I want to say, the 1960s. So Saudi Arabia today, plus minus 9 or 10 million barrels of oil a day, and a roughly 100 million barrels a day market. Most of it, half of it, comes from that Gawar oil field. They'll continue to be super important. They're leading the charge, Saudi Arabia are, in terms of cutting back production because commodities, of course, are priced at the margin. We know from as recently as the pandemic that that you don't easily turn off oil demand and fossil fuel demand. As much as we all believe in the green revolution and we'd like to make sure our planet's nice and green, we also want the lights to be burning. We want to recharge our phones overnight, our new Teslas. We want to use our stove to make our evening meal. And most Saudi Arabia, as much as anywhere, has the ability to turn on or off oil supply. They also want the oil price higher, of course. And importantly, U.S. energy production of oil production looks like it's probably peaked now in the shale oil. So, coming back to your question around what does Saudi Arabia mean for mineral investment, I think a bit like the Japanese or the Norwegians, the big sovereign wealth funds, they don't like to come down to the junior mining end of the world, sadly. And look, I've never been to Saudi Arabia, so this is secondhand looking in from afar. But I have watched them put money into Ivanhoe Electric. I mean, probably no better mining promoter than Robert Friedland. I did watch them take a 10% stake for $2.9 billion into the Vale base metal spin out. Mark Kudafani, who's the chair of that since July last month, he's actually an Aussie miner, by the way, living here in Italy, coming to keynote at a little conference we're hosting here at the end of September. So I'll ask Mark when I see him about the Saudis. But I think for now it's just at the big end of town. I think they'd like to get mineral expertise into Saudi Arabia as well. Barrick have got a small interest in a copper gold mine there in Saudi Arabia, but I think we're going to see them diversify their fossil fuel wealth into minerals as into other industries.
Is there opportunity for resource speculators in Saudi Arabia right now? Is there opportunity for a firm such as Arlington in Saudi Arabia right now?
I doubt it. Whether it be Saudi or Dubai or the Middle East, I've often not from time to time heard people say, go to the Middle East. There's all these petrodollars there, and there's lots of spare cash sloshing around. I personally have never gone there because it's I think it would take many years of investment to understand who the right people were to speak to. I do know people who've gone there and have spent lots of time and energy doing it, looking for money, looking for investors. But mostly I understand that that's been disappointing. Now, I think there's a different answer if you're Vale or BHP or you've got some large existing producing assets, I think, or if you're Robert Friedland. But I think for the junior mining sector or for Arlington as a participant in that, I don't think so.
Okay. General outlook for the rest of the year. We are really sitting in some precarious positions here throughout the metals complex, from precious metals to base metals here. But we're also seeing general macro environment in a very interesting position as well here, with bond yields selling off throughout not just the United States but globally, Simon. August, September, typically pretty volatile months no matter what year it is, and it's just not right now. What type of outlook do you have for the remainder of 2023?
So speaking for Arlington, which is my partner and friend Charlie and I, we are cautious. We've got some cash. We're conserving the cash we have to support the companies that we're invested in. We think the overall stock market looks extremely fragile. You and I were chatting earlier, Trevor, about the tech starting to roll over. The investor survey sentiment that I'm reading is surprisingly bullish. It seems that this sort of 15-20% rally in the S&P 500, led by 10 stocks for 2023, has increased confidence in the average investor. And actually, that's what it always does, of course. It sucks money in at the top and the money goes out at the bottom. Although as a resource investor, junior mining investor and financier, it feels like we've been now in this grind for 2 years. So,
Right.
The success of NVIDIA and the AI chips is completely irrelevant to all of my junior mining explorers and developers, because they're all down 20%. I mean, our good friends at Discovery Silver, gosh, we financed them at $1.20 back in March, April. We thought that that was silver gold about to take off, and the stock's now trading around 75 cents, in line with its industry peers, down 40%. That's how my precious metal sector looks, my precious metal holdings look at the moment. So overall stock market, think it needs to come lower. As you said, the treasury's back up. I think what will happen is we'll see the S&P 500 will be a tale of two halves. And for the materials, I think it will be the reverse. So the 15-20% gain in the S&P led by tech, I think that unravels in the second half. Why? Because the US economy does have this lagged effect to the higher interest rates. I think if the risk is that if China and Japan continue to sell treasuries, that as the economy slows and the profits slow and the stock market comes lower, at some point, I think if the sell-off in the US treasuries gets disorderly, the Fed will be forced to come back, reverse QT, as it's had to do in the past, and we'll get into QE. It will be called yield curve control. It'll be the Fed intervening in the 10-year and the 30-year to bring down that end of the market. And that will be the signal, the trigger for precious metals to really fly, I think. At the moment, real yields have been going up as measured by the Treasury Inflation Protected Security, or the TRIP yield. And I think we need that to stop. We need real yield to stop. We need the US dollar to stop being strong. And I think we're really close to that turning point. So I think we'll see rotation. At the moment, all of the news wires on China are overly bearish. So I think we're going to see some potential stimulus in China. Their economy will on a relative basis do better than the US and the rest of the world, because it's still growing ahead while the rest of the world slows down. And I think as the dollar weakens, the US economy weakens, and maybe some tinkering with the Fed and the yield curve, I think that precious metals will get going, and we'll see rotation into materials as China puts some gentle stimulus into their economy.
It sounds like moves from the same old playbook, with the exception of yield curve control here in the United States. I mean, that would be something relatively new to most investors, and most of the country.
Yeah, and of course, you know who invented yield curve control, don't you?
I do not, actually.
The Japanese.
Oh, yes. Oh, yeah. Okay.
Yeah.
I mean, I did not know they invented it. I knew that they had been implementing it for most of my lifetime.
Yeah, exactly. So they're taking the brakes off, and the rest of the world will have to think about doing more of it. We're hooked on the QE. I don't think that's going to change, and particularly if the 10 and 30-year treasuries yields continue to back up as Japan and China sell, and the oil prices going up. There's nothing more important than for the for inflation on oil prices. And you've got Saudi Arabia and OPEC. They know that because US production is now in decline, they can have an increasing effect on the oil price, and I think they'll succeed.
But doesn't if you use Japan's yield curve control as the focal point of the study, I mean, you can make the argument that Japan's economy did absolutely hardly anything that entire time. It was very stagnant. Couldn't you say that?
For the last 30 or so years, yeah, I think it was dropping in and out of sort of negative growth, 1% growth, and deflation, yeah.
I mean, is that the risk? Is that a risk you think a country like the United States is be willing to take?
I've read comparisons that more learned scholars and commentators than me have done, and arguing that, yeah, if you want to see where the US is going and the West in general is going, maybe more Europe than the US, because the US does, long-term growth, GDP growth is labor times productivity. If you look at labor and productivity growth in the US, it's better than Europe, for example, where I'm sitting now. So I think the Japanese deflationary experience, aging societies, and lower interest rates, I think that's more of a European risk than a US risk, because US does have this fabulous record of productivity. AI is the latest evolution of that, and it does have better demographics than places like Japan and Europe. But I also think that the Japanification of the US bond market is absolutely is something that we're going to continue to experience in the West, and that means more that the central banks have to own more of the yield curve, particularly in the case of the US. And this is specific to the gradual erosion of the US role as the reserve currency of the world, with China and others having pretensions to that, but still early days. That I think, that we are going to see the Fed have to play an increasingly active role in managing the treasury market.
Simon, it's a great conversation. We covered a lot of ground, basically the entire globe from east to west. I look forward to seeing you in Colorado here in a month. And, for anybody who maybe will also be attending the Precious Metals Summit or just want to follow up with you with any questions or maybe some ideas of what of doing work with Arlington, how do they reach out to you?
Well, look, come through our website, which is AGAM, that stands for Arlington Group Asset Management.co.uk. Send me an email to scat, SCATT, at agam.co.uk. As you mentioned, I'm going to be in Beaver Creek. I'm going to meet slightly offbeat from the usual mineral cotton path for me. I'm going to meet a helium guy. Helium? Did you say helium? Yeah. The commodity I think is actually the most interesting right now is helium, because it's a byproduct of natural gas. It's up 10 times in the last 10 years, but from what I'm reading, it's going to stay up. And what do you think helium's biggest use is, Trevor?
Well, I would assume balloons, but
Yeah,
no, that's not
exactly.
the answer.
That's the thing we all know is party balloons. Party balloons, by the way, are about 10% of helium demand. Seems like quite a lot. The biggest use up until this year was MRI scanners, because those
Ah,
machines that take the big scan of your body when you want to think if you've got a brain tumor or something, they need the helium. The key attribute of helium is it's a great thermoconductor, and it has the lowest boiling point of any element, minus 269 degrees Celsius. So they use
huh.
it to cool down the magnets as they zing around your head. That helium demand for MRI is actually falling because it's more expensive than it used to be. And the number one use today, growing double-digit rate, is semiconductors, because they use it to manufacture semiconductors, to make a sterile bubble to make them, and also to cool them down. And that's increasing double-digit. We know what's going on in the world, in China and the US, making more and more semiconductors. And the other cool use, which you can read about, is rockets. when you launch a rocket, if you're Elon Musk SpaceX, then you need helium to cool the off gases because it doesn't combust. And rocket demand's growing double digits as well. So helium's a really cool commodity where we've just started to pay attention to and just put a little bit of money into something just IPO today in Toronto called Pulsar Helium.
All right. I would love to meet him. Let's make an introduction here in a month's time. Simon Catt, pleasure to have you on, my friend. I thank you much. So thank you so much for doing this.
My pleasure, Trevor. Catch you in Colorado.
All right, everybody. That's a wrap here this week on Mining Stock Daily. We'll be back next week, obviously Monday morning with the morning briefing. And have a great weekend. Be well.